But let's move forward and bring on board Aditya Khemka, the fund manager at InCred PMS. He, of course, watches the pharma space very closely. And given the recent interest that we have seen in the pharma sector, we thought it's a good time to get a status check as to what's happening. Aditya, hi, good to be speaking with you. We understand with the latest, analyst estimates coming in that the drug shortage situation in US is actually abating. What's been your reading of the situation on the ground, and what does it mean for the Indian pharma players back home?
So yeah, I mean, the drug shortage situation in the US has been temporary, and we had expected it to be temporary. I think US FDA now has been far more diligent and proactive when it comes to acting on drug shortages than it has been in the past. And that basically means that the price escalations in drugs which have seen shortages would be short-lived. And we as a house have had a view that the US market is not really the best market for pharma companies to be investing in because profitability, revenue growth all seem to be very sporadic and not really structural. And therefore, we avoid investing in companies that have very large exposure to the US market. So yeah, that view remains. Drug shortages are coming down, and FDA has been more proactive than ever we have seen in the past.
Okay, point taken. But within pharma itself, it's become a lot varied, right? There's one diagnostic space, where there's one hospital space, CDMO, etc., etc. And of course, then the companies with a lot of, export exposure as well. Within all of these 4-5, subsectors, which is the one you think is best placed from a stock return point of view?
So from a stock return standpoint, I think the best placed subsector today is diagnostics. We feel that post-COVID, the investing population misread the decline in diagnostic revenues. Diagnostic revenues post-COVID declined because COVID-related tests and COVID-related diagnosis revenues just stopped. And the base business had begun to recover, but it was recovering slowly. Therefore, the stocks took a beating in terms of multiples, in terms of the earnings de-rating that we saw. And today, the stocks seem to have bottomed out because the normal business is growing now double digits. Even the entrance of new players like Tata 1mg, NetMeds, the investing public was very skeptical of how much disruption that discount that these online platforms are offering would create. But over the past 6 months, we have seen these online discounted platforms increase prices to the extent that they are now close to the prices of the incumbent players. And there has been actually no material disruption in the incumbents' revenue or volume or ASPs in terms of average selling prices. So yeah, I think diagnostics seems to be a place where price competition, etc., have been concerns which are unwarranted. And we have actually seen diagnostic players take price increases that will play out hopefully in the next 2 years.
I also want to talk about what's going on within specifically the hospital sector as well, because a lot of capex as well is coming on board. Yet at the same time, it's a very monopolistic sector with a very few players in there. How do you see this space evolving, say, in the next 2 to 5 years?
So hospitals is a wonderful business. In fact, I don't think many people in the investing street understand that barring FMCG is the only other sector that I am aware of that has negative working capital is hospitals. So the negative working capital indicates that when your profits grow by 100 rupees, your cash flow grows by 120 rupees or 110 rupees. And that's a fantastic business to be in as an investor. For the past 2 years, we've been extremely bullish on hospitals. We have taken very aggressive bets, and that has played out well for us. However, now we feel that most hospital stocks have rallied a bit too much and ahead of themselves in terms of valuations. So we are taking a more cautious approach to investing in hospitals today. But the business model and the ability to grow over the next 3 to 5 years is definitely there. We are just trying to be more smart in terms of what valuations we enter into such a space. And therefore, I think hospitals is something to keep on your watch list. And any material correction into hospital stocks could be bought into.
Right. Also wanted to understand, the commentary from the API majors that one is seeing right now, right? Still not giving much of a confidence, at least that is what the street understanding is. In a sense, they're still getting impacted because of high cost inventory, demand momentum, not that strong. Do you believe the worst is over for these companies, or we're still in that lean patch?
So look, the API CDMO business is a very heterogeneous business. No two companies are alike, so we can't really make statements basis the industry. It's a product specific industry where if a company's product portfolio is doing well, the company will do very well. At the same time, another company whose product portfolio is not doing well will not do well. So, we choose to bet on those companies within the API CDMO industry where the innovator related revenues are higher and the generic related revenues are lower. Because innovators as customers have more secular demand and they have more profitable demand. And they don't really care about pricing as much as they do about quality and supply. Whereas generics are more sticky on pricing and less, friendly with their vendors. So, the kind of API stocks that we like to own and we are currently bullish on are API companies that have more innovator-related revenue and less generic revenue. Having said that, from a broadly API sector standpoint, I think what is extremely positive right now is that the fact that China is producing raw materials at full pace and the pricing of raw materials is coming off. Now, when the pricing of raw material comes off, all API players make better margins because their contracts with their customers are slightly more sticky in terms of their pricing to their end customer. And if the raw material cost comes down, that sort of helps them to make better margins. The converse was true for the last 2 years where their pricing was fixed with their customers and the raw material prices were going up because China wasn't really producing enough raw materials. So, and the China plus one factor in API is definitely something that is happening. As many conversations as we have had with the industry, each and every player has alluded to the fact that they are getting more and more demand from customers who were earlier buying from China. And that seems to be definitely playing out. So I'm extremely bullish on this industry, but you have to be selective on what you buy. Because if you end up buying some companies with a product portfolio which is extremely commoditized and heavily competed by China, then you end up, may not be making much money.
We have to be very selective. Let's get stock specific. Aditya, tell us which are your holdings of the stocks that you like.
So in our InCred Healthcare PMS portfolio, we hold about 16, 17 stocks. The top 5 names that we hold are RPG Life Sciences, Thyrocare, Krishna Diagnostics, Healthcare Global, and Indoco Remedies. I mean, these are kind of the top 5 stocks that we hold.
That you have these mid-cap, small-cap names and not the Ciplas and Sun Pharmas of the world, or even Orindo Pharma for that matter. In fact, Aditya, if I can ask you specifically on Orindo Pharma, there seems to be a lot of interest which is coming back in the stock. What would be your view, if at all?
So we don't own Orindo Pharma. We don't have a significant view on the name. The only thing is that I can share with you is that Orbindo's primary bread and butter is the US generic business, whereas the shortages are coming down, the pricing environment is difficult. The US FDA is being extremely proactive in terms of inspections and trying to ensure that there are no shortages in the US market. So these things basically keep us at bay from owning any of the larger names that you suggested, because all of those larger names have a material exposure to the US generic business. And that's a business which we have seen historically cyclical, low return on equity business, low margins, and very lumpy in terms of certain quarters turn out to be really good, certain quarters turn out to be really bad, which basically leads to a lot of volatility in stock prices. And if you look at the risk-adjusted returns of stocks like these larger companies, it doesn't justify an investment.
That's a fair point to make. Aditya, on that note, we let you go. Appreciate you joining us and talking to us about what's happening in the pharma space and what looks attractive at this point of time. But for now, taking a breather on the show, don't go anywhere.